There are moments in financial history when a tiny group of people act long before the rest of the world realizes what's coming, and they make fortunes from a disaster everyone else walks straight into. In 1929, Joseph Kennedy stepped out of the market months before the crash, and then made millions shorting the very stocks that would fall 89%. In 2008, Michael Burry and John Paulson bet on the collapse of subprime mortgages, while Wall Street was still celebrating a new era of housing stability. And they walked away with over $1 billion when the system cracked. Every time they were mocked, every time they were told they were paranoid, and every time they were right. Now, in 2025, the same pattern is unfolding again, not vaguely, not loosely, almost identically. The same four-stage sequence Kennedy followed in 1929, the same four-stage sequence Burry and Paulson followed in 2008, and those same four stages are being repeated today by the most informed, most data-driven investors in the world. While markets hit record highs, while AI is celebrated as the engine of a permanent productivity boom, while retail investors pile in believing the rally is unstoppable, these people, the ones who never move without reason, are quietly repositioning. This is the beginning of what I call the crash profit pattern, a mechanical behavior cycle that shows up every time markets reach extreme valuations. It's not superstition, it's not prophecy, it's arithmetic, incentives, and human psychology converging into the same predictable outcome. This pattern made billions in 1929, it made billions in 2008, and if history repeats, and it always does when conditions match, it will make billions again. Stage one is always the same. Exit while everything still looks perfect. That's why Kennedy sold into the euphoria of 1929. That's why Burry began building subprime shorts in 2005, long before the public saw any danger. That's why Paulson quietly accumulated credit default swaps in 2006, while economists said housing never falls nationwide. And it's why, right now, the most successful investors of our era are acting in ways the public has not yet understood. Because before every collapse, there is a moment when those who see the numbers clearly stop trying to win more and start trying not to lose everything. Stage one of the crash profit pattern is always the same. The smartest money exits quietly, systematically, long before the crowd notices anything is wrong. And when you look closely at 1929, 2008, and 2025, the symmetry is almost unsettling. In the mid-1920s, Joseph Kennedy didn't just get lucky. He understood leverage, credit cycles, and the psychology of crowds. By 1929, margin debt had exploded to levels no one had seen before. Investors borrowing 90% of a stock's value just to buy more stock. Kennedy knew that if prices fell even 10%, the entire structure would unwind. That's why he liquidated through the summer and early fall of 1929. He didn't wait for headlines. He didn't wait for panic. He acted when everything still appeared perfect. 7 weeks after he exited, the Dow hit its all-time high and then began the most violent collapse in modern market history. Fast forward to 2005-2007. Michael Burry saw something the entire housing industry refused to look at: loan-level data. Adjustable rate mortgages resetting in 2007, subprime borrowers already missing payments, banks stuffing the worst debt into AAA-rated securities. He wasn't predicting the future. He was reading the present correctly. And because of that, he began shorting mortgage bonds 2 to 3 years before the crash. Paulson did the same. He didn't just bet against housing. He targeted the exact tranches most likely to implode, building billions in credit default swaps at precisely the moment the public believed the housing market was invincible. Their early moves looked foolish until they suddenly looked brilliant. That's stage one. Exit early, position early. Don't wait for confirmation. Which brings us to now. In 2025, the people who see the real data, the insiders, the executives, the institutional allocators, are behaving exactly like Kennedy, Burry, and Paulson did before their respective collapses. Warren Buffett is sitting on the largest cash position in market history, more than $300 billion, explicitly stating in his 2024 shareholder letter that he can't find anything attractively priced. In Buffett speak, that's not caution, that's a siren. Jeff Bezos has sold over $13 billion of Amazon stock across 2024 and 2025. Mark Zuckerberg has sold billions in Meta shares while the stock hit record highs. Jamie Dimon, who hasn't sold a single share of JP Morgan during his entire tenure as CEO, sold for the first time in nearly 2 decades. This isn't normal behavior. This isn't routine diversification. This is a coordinated retreat by people who have the best internal information on Earth. Executives know their real sales numbers. They know their declining customer pipelines. They know the cost pressures hidden inside corporate earnings. They know which divisions are slowing, which markets are cracking, and which debts can't be refinanced at today's rates. And they're selling hard. Insider selling across corporate America has reached levels not seen since 2007, the year right before the financial crisis. Meanwhile, the Buffett indicator, which compares total stock market value to GDP, sits near 185%. Buffett himself has repeatedly said that anything above 120% indicates dangerous overvaluation. At 185%, the message isn't subtle. The market isn't overpriced. It's primed for rupture. And the smart money isn't trying to time the top. They're doing what they always do in stage 1, exiting gradually, over 12 to 18 months, so they don't cause the crash themselves. While retail investors are buying the dip, while financial influencers are screaming about generational wealth opportunities, while AI narratives convince the public that this time is different. Stage 1 is nearly complete. Stage 2, the stage where real fortunes are made, comes next. Stage 1 of the crash profit pattern is about exiting quietly. Stage 2 is different. This is where the smartest investors don't simply step away from risk. They pay for risk to explode, long before anyone else believes a crash is even possible. And historically, this stage is where the biggest asymmetric profits begin. In 1929, the closest thing to volatility insurance was short selling. After Joseph Kennedy and Bernard Baruch moved out of their long positions, they started borrowing shares and selling them into a market that was still climbing. Shorting stocks while the Dow hit one record after another looked reckless at the time. But Kennedy understood the mechanics. Margin debt had ballooned to extreme levels. With investors borrowing up to 90% of a stock's value, even a modest decline could trigger forced liquidations. Every dollar Kennedy spent maintaining his short positions functioned like an insurance premium, small, controlled losses, in exchange for the chance of an enormous payout. When the first cracks finally appeared, that's exactly what happened. Black Thursday, Black Monday, Black Tuesday. Over 3 years, the market lost 89% of its value. Kennedy's insurance paid out massively. What looked foolish on the way up became genius on the way down. The same pattern appeared in 2008, but with far more sophistication. Shorting wasn't the main play anymore. Credit default swaps became the new insurance, contracts that paid if debt failed. Michael Burry spent months buying these swaps while his investors were furious, insisting he unwind what looked like a disastrous bet. But Burry wasn't forecasting the future. He was analyzing the present. Loan-level data showing subprime borrowers already falling behind, adjustable rate mortgages set to reset at unaffordable levels, and banks stuffing the worst loans into supposedly safe securities. Burry paid premiums while Wall Street laughed at him. Then defaults surged, bonds collapsed, and those swaps returned 100 to 1. Paulson followed a similar playbook, targeting the exact tranches most likely to implode. Their profits were not accidents. They were the mathematical consequences of stage 2 behavior. That same behavior is happening again in 2025. Today's volatility insurance has several modern forms: put options, VIX calls, and credit default swaps on fragile debt sectors. If you track institutional activity, not retail sentiment, the signals are unmistakable. The put-call ratio, which normally sits around 0.6 to 0.8, has repeatedly stayed elevated above 1 throughout 2024 and 2025. Retail investors rarely buy puts, they chase upside. Institutions, on the other hand, hedge quietly and early. Elevated put buying means they're preparing for turbulence long before the public sees any danger. Even more telling is the surge in VIX call purchases. Large coordinated blocks of VIX calls, with expiration dates in mid-2025 and late 2025, have been bought by institutions. These orders are far too large for retail traders. They're too expensive to be random speculation. These are intentional insurance premiums paid months in advance, just in case volatility erupts. But the clearest echo of 2008 is the explosion in credit default swap prices tied to commercial real estate and corporate debt. Since 2021, the cost of insuring these bonds has risen 300 to 500%. Office buildings across major cities are still 40 to 50% vacant. Properties financed at 3% interest must now be refinanced at 7 or 8%, numbers that simply don't work. Entire categories of commercial debt are mathematically impossible to survive under current rates, and someone is preparing for that collapse. Even hedge funds have begun hinting at their hedges. Bill Ackman, for example, has mentioned taking positions similar to the ones he held in early 2020. Hedges that return nearly 100 to 1 in under a month. Hedge funds rarely announce moves like this, unless they've already positioned themselves, because secrecy is part of their edge. All of this, quiet hedging, increased insurance, rising CDS cost, and institutional preparation, is pure Stage 2 behavior. It matches the timing, it matches the tone, it matches the strategic logic of 1929 and 2008. But Stage 2 is only the setup. The real money, the generational fortune-making, begins in Stage 3. That's when sophisticated investors stop applying broad hedges and start targeting the exact sectors they know cannot survive the coming stress. In 2008, the weak point was subprime. In 2025, the weak points are different, some obvious, some disguised as strong fundamentals. And Stage 3 is where the precision starts. Stage 3 is where the crash profit pattern becomes unmistakable. If Stage 1 is about stepping aside, and Stage 2 is about securing protection, then Stage 3 is about aiming directly at the weak points in the system. This is the moment when the smartest investors stop hedging broadly and begin targeting the exact sectors they know will break first. It's not about betting against the market as a whole. It's about identifying the pressure points where the collapse must mathematically begin. That's how it worked in 2008. Burry didn't short housing generically. Paulson didn't bet against the entire financial sector. They isolated specific tranches of subprime mortgage bonds, bonds built on adjustable rate loans in California, Florida, Arizona, and Nevada, where speculation was densest and defaults were inevitable. They weren't simply betting that markets would fall. They were betting that certain parts of the market would fall hardest, fastest, and deepest. That precision is what turned millions into billions. The same dynamic existed in 1929. The crash didn't start with the entire economy collapsing at once. It began with over-leveraged brokerages, margin-dependent speculators, and companies stuffed with short-term debt. Kennedy and Baruch didn't short random stocks. They targeted the firms most exposed to cascading liquidation, firms that would be forced to sell assets into a falling market. Once those dominoes fell, everything else went with them. Today, in 2025, the weak points are different but just as fragile. The first pressure point is commercial real estate, an industry already cracking under structural changes. Office buildings in major cities sit 40 to 50% vacant, thanks to remote work that never reversed. Properties purchased in 2019 and 2020 using cheap 3% loans are now facing refinancing at 7 or 8%. Income is down, debt obligations are higher. Many buildings aren't worth the value of their mortgages anymore. When owners walk away, and they will, someone has to absorb the losses. The institutions buying default insurance on commercial mortgage-backed securities know exactly what's coming. This is subprime all over again, just in a different costume. The second pressure point is corporate debt, specifically the mountain of low-interest loans taken out between 2010 and 2021. For more than a decade, companies leveraged up aggressively, issuing bonds at rates so low they barely covered inflation. But those bonds are now maturing in an environment where refinancing costs have doubled or tripled. A company that could service a 3% interest rate cannot necessarily survive at 7%. That math is unforgiving, and the defaults have already begun. Institutional investors aren't shorting the companies directly. They're buying credit default swaps the same way Paulson did. They know which firms can refinance and which ones can't. The third pressure point is regional banking, a sector deeply tied to both commercial real estate and local corporate lending. Regional banks hold disproportionate exposure to office buildings, retail centers, and mid-sized corporate loans. When those assets fall, the losses land on the bank's balance sheets. Silicon Valley Bank, Signature Bank, and First Republic were early hints of the stress, but not the end of it. Investors who understand the banking system structure are already positioning for a second wave of failures. The fourth pressure point is consumer credit. Credit card balances and auto loans reached record highs in 2024 and 2025, with interest rates hovering at the highest levels in decades. Delinquencies are rising across every income bracket. Households are stretched thin, and any economic shock, job losses, layoffs, recession, will accelerate the collapse of consumer debt quality. The retail sector will suffer next, followed by discretionary industries, and eventually credit-dependent companies that rely on strong consumer spending. And all of these weak links are connected. When commercial real estate defaults rise, banks take losses. When banks restrict lending, companies can't refinance. When companies default, unemployment rises. When unemployment rises, consumer credit cracks. When consumer spending falls, earnings collapse. And when earnings collapse, the market finally sees what the insiders saw 12 to 18 months earlier. Stage 3 is about targeting these exact points before the cracks turn into fractures. It's a transition from defensive positioning to offensive profit-taking, and the investors who understand this cycle are already preparing for the next stage, the one that turns every crisis into a once-in-a-generation buying opportunity. Because after Stage 3 comes the most dramatic reversal in the entire pattern. Stage 3 is the precision strike, finding the exact fault lines where the system will break. But Stage 4 is something entirely different. It is the moment the crash finally begins, and the math that insiders have been preparing for becomes unavoidable. This stage is where fear replaces optimism, forced liquidation replaces confidence, and markets shift from slow deterioration to violent acceleration. It's also the stage where the investors who followed the pattern stop betting against the system and start preparing to buy it back at fire sale prices. To understand Stage 4, remember how crashes actually unfold. They don't begin with catastrophe. They begin with a catalyst that seems manageable. In 1929, it was a series of minor declines after years of relentless growth. In 2007, it was rising mortgage delinquencies that most analysts dismissed as contained. In both cases, the first drop wasn't the disaster. It was the spark that ignited the leverage stacked beneath the surface. The same will happen in 2025 or 2026. Markets today are supported by unprecedented levels of margin debt, corporate leverage, government deficits, and derivatives exposure. When a downturn begins, whether triggered by commercial real estate defaults, a major corporate bankruptcy, a regional bank failure, or something entirely unexpected, the selling won't stop naturally. It will cascade. Leveraged investors will be forced to unwind. Funds depending on stable volatility will be liquidated. Banks holding bad loans will restrict credit. Companies unable to refinance their debt will collapse. And once the forced selling begins, it feeds on itself. This is why insiders exit early. This is why they buy insurance months, sometimes years, before the public sees any danger. By the time headlines confirm what they already know, they're not losing money. They're liquid, waiting. And once the crash becomes undeniable, Stage 4 begins. Prepare to buy everything the public is dumping. This is the step that transformed ordinary fortunes into generational wealth in every major crash. Joseph Kennedy made millions shorting the 1929 collapse, but he made far more buying companies and real estate in the early 1930s for pennies on the dollar. Burry and Paulson made their initial billions from credit default swaps, but their longer-term gains came from buying distressed assets after the panic. The investors who followed the pattern didn't just profit when markets fell. They profited again when markets recovered, because they were the only ones left with capital. The same logic applies to 2025 and 2026. Smart money isn't preparing for a crash just to avoid losses. They're preparing so they have cash, massive amounts of cash, when assets hit levels and that will never be seen again in our lifetime. Companies with strong cash flow will trade at historic discounts. Real estate in prime locations will be marked down to liquidation levels. Tech stocks that were irrationally priced in 2024 and 2025 will fall so far that their valuations will once again make sense. Not everything will recover, but the things that do will multiply in value. This is what Stage 4 investors wait for. The moment when panic turns opportunities invisible to everyone, except those who prepared. But here's the part most people never understand. Crashes do not reward intelligence. They reward positioning. By the time fear sets in, it's already too late to be rational. The public sells everything at the bottom because their emotions override their strategy. Institutions without hedges sell because regulations force them to reduce risk. Pension funds sell because withdrawals spike. Hedge funds sell because margin calls leave them no choice. Meanwhile, the investors who followed the crash profit pattern aren't selling. They're watching. They're patient. And when the forced liquidation reaches its peak, when valuations detach from reality, they start buying. This phase doesn't last long. In 1929, the deepest discounts existed for less than a year. In 2008, the bottom of the market lasted weeks. Stage 4 is fast, violent, and unforgiving. Only the prepared survive it. Only the liquid capitalize on it. And that sets up the final stage, Stage 5, when the system stabilizes, markets begin to recover, and the people who positioned correctly come out not just intact, but dramatically wealthier than before the crisis began. Stage 5 is the point in the crash profit pattern where the panic finally exhausts itself. Forced sellers run out of assets to dump. Margin calls stop accelerating. Bond spreads tighten. Volatility falls from chaos back to discomfort. The system hasn't healed, not yet, but it has stopped bleeding. This is the part of the cycle the public always misreads. They see the market stabilize and think the danger is past. But the investors who follow the pattern know the truth. This is the moment to strike. When the bottom forms, it always looks like the end of the world. In 1932, stocks were down nearly 90% from their peak, and newspapers were calling capitalism a failed experiment. During the 2008-2009 collapse, major banks were trading below liquidation value. Blue-chip companies were priced for bankruptcy, and commentators predicted a second Great Depression. The public saw doom. The insiders saw prices that would never exist again. This is when Joseph Kennedy bought huge stakes in companies that would rebound for decades. This is when Paulson shifted from defensive trades into distressed assets. This is when Burry loaded up on undervalued equities that would rise 200 to 400% as the recovery took shape. In every crash, the biggest fortunes aren't made during the fall. They're made during the rise that follows, when assets recover from irrational lows created by fear, not fundamentals. And that leads us to today. If the warnings of 2025 and 2026 play out like history, and all available data suggests they will, Stage 5 will present the same extraordinary opportunity, but only for those who survive the earlier stages. When markets plunge 40%, 50%, or even more, the public panics. They sell their retirement accounts. They sell at the bottom. They capitulate. But the investors who recognize the pattern in advance will be doing the opposite. They'll be identifying companies with strong cash flow but temporary price distortion. They'll be buying real estate that was over-leveraged by its previous owners. They'll be accumulating commodities, infrastructure, and technology assets that will lead the next cycle. Once Stage 5 begins, the entire dynamic flips. Fear becomes fuel. Cash becomes leverage. Patience turns into power. What looked like disaster becomes the richest moment in the economic cycle, for those positioned correctly. Then comes Stage 6, the quiet part. The recovery that feels strange at first. At the end of every major crash, markets rise long before the economy does. Unemployment is still high. Corporate earnings still look weak. News headlines stay negative. But insiders aren't watching headlines. They're watching liquidity, credit spreads, refinancing activity, and flow of funds. When these begin to heal, the full recovery starts. The public always gets this stage wrong too. When markets rise 20%, they think it's a dead cat bounce. When they rise 40%, they think it's temporary. When they rise 60%, they say, "I'll buy after the next dip." By the time the new bull market is obvious, insiders have already doubled or tripled their positions. This is why the crash profit pattern is so powerful. It's not luck. It's not timing the top or guessing the bottom. It's following a sequence of behaviors that is repeated across every major crisis. 1929, 2008, and now again. Right now, in 2025, The smart money has already completed stage 1, is deep into stage 2, and is positioning for stage 3. The public is still in denial, just as they were in 1929 and 2008. But the insiders aren't guessing. They're preparing. If the pattern completes, and history suggests it will, 2026 will not just be a year of chaos. It will be the greatest wealth transfer of our era. The question is not whether the pattern is real. The question is whether you recognize it before it's too late to act. Here is a moment at the end of every cycle when the pattern becomes visible. Not just to analysts or insiders, but to anyone willing to look honestly at the data. In 1929, that moment came when margin calls spread faster than credit could contain them. In 2008, it came when subprime defaults revealed the structural rot beneath the housing market. And in 2025, that moment is emerging again through insider selling, unprecedented leverage, commercial real estate cracks, and the quiet but deliberate repositioning of the world's most informed investors. The crash profit pattern isn't superstition. It isn't fear-mongering. It's the repeated choreography of capital under stress. Exit early, buy insurance, target the weak points, prepare for liquidation, accumulate at the bottom, ride the recovery. This is how Kennedy survived the Great Depression. This is how Burry and Paulson turned skepticism into billions. This is how every major hedge fund that understood 2008 came out wealthier than before the collapse. And it's how a small group of investors is positioning right now. If the cycle completes, and all current conditions suggest it will, then the next 12 to 24 months will reshape wealth in a way most people only understand in hindsight. Some will be destroyed because they believed the rally was permanent. Some will panic sell at the bottom because they never expected a downturn. But a small group, the group that recognizes the pattern, will treat the collapse as preparation, not punishment. They will survive the fall because they planned for it. They will buy when fear is at its peak because they held cash. They will rise with the new cycle because they understood the old one was ending. History doesn't repeat perfectly, but the incentives driving human behavior do. And when valuations stretch, leverage builds, insiders exit, and protection surges, the outcome is never ambiguous. The crash is not the end of the story, it's the turning point. The question is whether you reach it blind or ready.